You see 0.63 on a prediction market screen. Your first instinct might be to translate that into, there is a 63% chance this event happens. But that number is a trap. It is not a clean probability. It is a compressed mixture of information, liquidity, risk appetite, and rule design. In this analysis, we will tear apart what that 0.63 actually means, why it is dangerous to trade on, and how to build a research framework that separates signal from noise. We will cover contract semantics, market microstructure, constraint arbitrage, and the pitfalls of backtesting. By the end, you will understand why the most professional trade is often no trade at all. A displayed price like 0.63 is not a single truth. It is the outcome of 6 distinct layers. First, the contract itself. You are not trading Bitcoin or an election, you are trading a specific sentence. Change one word, touch, versus close above, and you have a different asset. Second, the quote, 0.63 might be the midpoint, but the best bid is 0.58 and the best ask is 0.68. That 10-point round-trip friction is real. Third, the composition of market consensus. It is information weighted by capital, but also by liquidity, risk appetite, and fees. Fourth, time. A contract expiring in 2 hours has a different risk structure than one expiring in 6 months. Fifth, settlement rules. The rulebook decides who gets the dollar, not the headline. Sixth, the relationship to external markets. A probability rise might reflect tail risk, not a directional move. To understand what a prediction market price really reflects, we can think of it as a function of information, capital, and frictions. The price is not just the probability, it is the probability adjusted by how much money is behind it, how much it costs to trade, and the risk appetite of the participants. This decomposition helps us see why a price can be stale or manipulated. Before you even think about alpha, you need a research ledger. The first column is not the price, it is the full contract proposition. The second is the expiration time, time zone, and settlement window. The third is the trigger type, touch, close, range, or conditional. The fourth records the specific data source, dispute resolution, and final pricing mechanism. Only then do you fill in the bid, ask, midpoint, and last trade. This order matters because 2 contracts with identical titles but different settlement sources can produce completely different outcomes. The most common mistake is to look at the price first and then guess what it represents. The correct order is to prove comparability before you allow 2 contracts into the same table. Imagine a prediction market probability jumps while Bitcoin spot barely moves. You might think it is a leading signal. But that same picture could be 4 different mechanisms. The first is cross-market prediction. The probability change has predictive power for future returns. The second is relative value. 2 markets price the same event differently. The third is statistical arbitrage. A stable relationship exists and you trade the deviation. The fourth is event-driven. New information is being absorbed at different speeds. The trading action might be identical, by Bitcoin, but the research question is completely different. You must know which one you are testing. To prove that a prediction market leads Bitcoin, you must pass 3 trials. The first is the timestamp trial. Are you using trade time, server time, or scrape time? A misalignment of even a few seconds can make a lead look like a prophecy. The second is the common cause trial. A news event might hit both markets simultaneously, but one updates faster. That is not prediction, it is faster data diffusion. The third is the executability trial. When the signal fires, is there enough depth to actually trade? After slippage and fees, does the edge survive? A robust experiment fixes the event pool, observation window, and prediction horizon in advance, then runs rolling out-of-sample tests, separating news periods, high volatility periods, and low liquidity periods. One of the most powerful tools in prediction market analysis is the monotonicity constraint. If 2 contracts are identical except that one has a higher barrier, the higher barrier must have a lower or equal probability. For example, the probability of Bitcoin touching $120,000 should never be higher than the probability of touching $110,000. When you see a violation, you have found a logical inconsistency. But that inconsistency is not automatically profit. You must check if the mispricing is tradable given the bid-ask spread and depth. To ground our discussion, let's look at Bitcoin's recent price action. Over the past 3 months, Bitcoin has traded in a range roughly between $57,700 and $67,400. The latest close is around $62,400. This range-bound behavior is typical of a market waiting for a catalyst. Prediction markets might offer clues about which direction that catalyst will push, but the price itself tells you that the market is not trending strongly. This context is crucial. A leading signal from Polymarket is more valuable in a range-bound market because it might anticipate the breakout. When you find a potential mispricing, you must compute the tradable edge. This is not just the difference between the theoretical probability and the market price. It is the expected profit after accounting for the bid-ask spread, fees, and the probability that your order fills. The formula is simple, but the inputs are hard to estimate. You need real depth data and a realistic execution model. Prediction markets offer 5 distinct classes of opportunity. The first is constraint arbitrage, exploiting logical inconsistencies, like the monotonicity violation we discussed. The second is cross-sectional relative value, comparing similar contracts to find outliers. The third is cross-market lead lag, using Polymarket as a sensor for Bitcoin moves. The fourth is event-driven drift, trading the slow absorption of news across markets. The fifth is microstructure and liquidity, profiting from order book imbalances or stale quotes. Each has a different risk profile and data requirement. Constraint arbitrage is the most logical but often has small capacity. Cross-market lead lag is easy to integrate but prone to false leads. Microstructure opportunities are high frequency but require excellent data and execution. The biggest gap between backtest and live trading is execution. In a backtest, you can assume you buy at the midpoint. In reality, you might be the one moving the price. For a multi-leg arbitrage, you need to fill all legs simultaneously. But the second leg might disappear while you are filling the first. Partial fills turn a risk-neutral position into a directional bet. You must simulate order queue, partial fills, and the possibility of failed legs. Also, consider the difference between holding to settlement and closing early. Holding to settlement reduces exit friction but increases capital lockup and rule risk. Closing early releases capital but might cost you a wide spread at the worst time. If you already have a Bitcoin trend-following system, do not replace it with a Polymarket signal. Instead, use prediction markets as an overlay. There are 4 ways to integrate: as an entry filter, a position sizer, a position manager, or a risk switch. As an entry filter, you only take trend signals when the prediction market is also improving. As a position sizer, you increase size when the probability is moving in your favor. As a position manager, you hold longer when the probability continues to improve, and cut when it stalls. As a risk switch, you reduce exposure when the prediction market structure is unhealthy, like when the monotonicity constraint is violated. The key is to treat Polymarket as a voting member, not the final judge. A high Sharpe ratio in a backtest is not proof of a real edge. It could be the result of look-ahead bias, survivorship bias, or overfitting. In prediction markets, the most common trap is using the midpoint price instead of executable prices. Another trap is ignoring the fact that contracts expire and new ones are created, so the data series is not continuous. You must use walk-forward analysis, where you only use data that was available at the time. Also, beware of the paper high Sharpe illusion, a strategy that looks great on paper but cannot be filled in reality. Always stress test your results with conservative cost assumptions and check if the edge survives after removing the top 5 best trades. The probability jumped 8 points, but futures barely moved. Is this a leading signal? It could be. But first, check the order book. Is there enough depth to trade? The best bid is 0.58, ask is 0.68. The midpoint is 0.63, but the spread is wide. That means the 8-point jump might just be a small order on a thin book. Also, the contract is about touching $120,000, not closing above. Futures are about current price. Exactly. They are not the same bet. You need to align the definitions before drawing conclusions. Prediction markets are not crystal balls. They are information compression engines with noise, friction, and rule risk. The professional approach is not to worship the probability number, but to deconstruct it. Ask, what is the exact proposition? What are the settlement rules? Is the quote executable? Are we comparing comparable things? Only when you have a clean proposition, a healthy market structure, and real depth can you consider the price as a signal. And even then, you must stress test it against alternative explanations. The most valuable skill is knowing when the evidence is insufficient. That is why we emphasize a research ledger, a validation hierarchy, and a falsification checklist. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.